Well, hello. We are back. I am Andy Green with Green Group Real Estate, and I am joined today again by Annie Ransom with All Pacific Mortgage. Say hello, Annie.
Hello, everybody.
And why we're here today is because, more than anything, you all know that there is so much going on in the world right now. The world is changing by the minute, by the day, by the week, and we'll see what happens in the next month. And the reality is it is changing at a dramatic pace, and that affects you, it affects me, it affects Annie, it affects all of us. And there's so much negativity in the media, and our role and our mission is to really combat that negative media and provide you with real-time information that you can use and you can implement into decisions that you're making today and in the future to make smart decisions, right? Right.
That's
and
right.
I forgot to start my video, so I'm going to do that real quick. Annie, why don't you just tell them a little bit about yourself?
So I'm Annie Ransom with All Pacific Mortgage. I'm the branch manager over here, but also run a book of my own business. I've been in the industry for almost 15 years and got in right when we had a similar experience to the housing market, real estate market. But of course, we're in different times now. And so I'm really excited to be a part of this journey and help keep people informed as much as possible so they can make good, educated decisions along the way.
That is right. Absolutely. Smart choices. That's what we're after. Right. So what are we going to be talking about today? We are going to be talking about, will surging unemployment crush home sales? I just don't believe that there's a lot of other topics that are more important that relates to your finances, your housing, mortgage, and that's what we do. And so we're here to provide you with the information that makes sense to you and just give you that information. So unemployment and home sales, how do those two go together, Annie?
Well, if you're unemployed, it makes it pretty darn hard to buy property.
Yep, it does. Let me pull up some slides that I put together here real quick. So I'm going to share my screen. And hopefully this works because technology sometimes is not my best friend. And we'll see, it did not work. Let's try this.
I'm here. Yep. I'm here.
Okay. Everything just completely paused there for a second.
Can you hear me?
Let me try this again.
Oh.
Yep, I can hear you. Technology.
Okay. I know.
Okay, I'm going to remove that. And we might just have to talk through it, but it would really be helpful. And I know that it worked last time. Oh, shoot.
Nope.
Did not work. Okay, so we're gonna get after it then, because sometimes you just have to adjust, modify, and move on. So will surging unemployment crush home sales? And the reality is 10 million Americans have lost their job over the past 2 weeks. And the next announcement for the unemployment rate is going to come on May 8th.
Wednesday.
On May 8th. And do you know what we're expecting to hear?
Unfortunately, it doesn't sound like it's going to be very good news.
It is not.
Yeah.
So estimates are that it is going to hit 20 million. 20 million unemployed Americans. That is a big number, isn't it?
Yeah, sure is. Yes.
So let's talk about what sort of an impact that's going to have on the U.S. And one quote that I want to throw out there by the president of the Federal Reserve Bank of St. Louis is, "This is a planned, organized partial shutdown of the U.S. economy in the second quarter. The overall goal is to keep everyone, households, and businesses whole." have you looked into the stimulus package and everything that's going to entail? It's 800 pages.
Yeah, I haven't read every single page, but I have a pretty good handle on what that means. And I do have to say, I think that this stimulus package and getting ahead of things is really going to be the ticket. Businesses will eventually come around. The government's trying to protect them, so a lot of these businesses don't fail during all of this. So I do think that they are doing a great job of trying to keep families protected through all of this, and hopefully come out of this a lot quicker than without the plan.
Right. And, I think that's going to be debatable on both sides, because you hear, differing
Sure.
opinions. And just my opinion as well is that they are very motivated to keep families and businesses whole, as they described. And is it going to be perfect in the very beginning? No. We've never been through anything like this in our lifetimes. And, this was the first draft. And I know that the amount of money probably is not going to be enough.
Sure.
And there's going to be a second round. They will evaluate what happened the first round. They will make adjustments, and they want to get America back on its feet. And is it going to happen overnight? Negative. It's going to take a little bit of time. It is just going to take a little bit of time. So that means that 15% of Americans will be out of work. So let's take it one step further and talk about another concern is how badly will the U.S. economy be damaged if people can't buy homes. So what I'm going to do is if you just comment on this stream, I will send you a copy of the slides, because it really is eye-opening to be able to see them. And, I might take a minute to see if I can get them back online. And I apologize for that. And we're still figuring this out. And as I mentioned, it's our goal to get you guys this information. I am not IT. I am alone in my office and have been for 3 weeks. So, like you guys, I'm just doing the best that I can, right?
Right.
That's
right. Yeah.
So what the graph shows is the annual house appreciation over the past 6 years in correlation to home sales. So unemployment rate compared to home sales. And like, is there a correlation between those two historically? And if you go back to 1989 and look at the time frame between 1989 to the early 90s, unemployment was up to 7.5%. And you saw a steady rise in home sales every single one of those years. So 7.5% unemployment in the early 90s, and a steady increase in home sales. And let's jump forward to the 2000s. What happened in the early 2000s, Annie?
Unemployment numbers dropped significantly. So technology, lots of booming companies, economy is doing great.
Yep. So they went down the early 2000s, and then from about 2000 to looks like about 2004, they started increasing, not dramatically, but it got up to in 2003, 4, up to 6%. So that's 6%, and still home sales were dramatically rising at that point. I mean, you remember what was happening in 2004 and 5, right?
Oh, sure.
Yeah, we talked a little bit about that. I think it was a week, or actually 2 weeks ago, we talked about that, and the availability of cash and financing, and the ease to get a mortgage. And in 2005, you saw a peak in home sales. 2006, it dropped, and then 2007 dropped dramatically. And during that time frame, from about 2006 to 2010, 2011, unemployment went up to 9.6%. 9.6% unemployment, and home sales dropped and stayed flat. They stayed flat. And then from 2011 to 2019, they just steadily increased, and unemployment rates went down during that whole time period to about 4%. And I think that just before this happened, we were at a 50-year record low for unemployment at 3.5%. Does that sound right, Annie?
That sounds right.
Yeah, 3.5% record all-time low. And fast forward 1 month later, and 10 million Americans have lost their jobs.
Right. Have you heard what the prediction is of what we anticipate?
20 million. 20 million and about 15% is what Goldman Sachs has estimated will hit by, I think they said, the third quarter of this year. And we're actually going to talk about that here in just a second. Why don't we just go right to that? So let's just recap real quick before we jump forward and talk a little bit more about that. But how has unemployment rate affected home sales in the past? So to recap, between 92 and 93, unemployment was rising and home sales increased. So unemployment rising, home sales increased. From 2001 to 2003, unemployment was rising again and home sales increased. And then unemployment rate between 2007 to 2010, it was rising again, and home prices significantly decreased. And that had a lot to do with the mortgages and the housing crash, which is just a much different time than we're experiencing right now, right?
Yeah, absolutely. Hey, Andy, in your opinion, why do you think that is? Between, and during the the 90s and the early 2000s, why would housing prices increase when there's lack of jobs?
Well, what happened in the 2000s was we had we had so many good things going for us in up until about 2006, 7, or 8, depending on which market you were in. At the time, I was in Boise, Idaho in 2005, and it was the third fastest growing city in the U.S. And the available financing was unbelievable. A lot of subprime loans, and it was propping up the housing market, and the economy was still really good. So you just saw a home appreciation increasing dramatically over that time frame, and people were using the equity in their homes as ATMs. And so it was pushing a lot more money into the economy. And then all of a sudden, the bubble just completely burst.
Sure.
And then we started to see the increase in unemployment rate dramatically during that time, right?
Right. Yeah, sure.
Yeah.
Yep.
Okay. So let's move on for a second. Let me get to the next slide here. So let's talk about unemployment rates compared to past financial crisis, which is what we were just talking about. So going back all the way to the Great Depression from 30 through 35, unemployment rate rose from 1930, 8.7%, all the way up to 20.1% in 1935. Could you even imagine?
No.
I couldn't either.
Yeah.
I guess we're going to get a little taste of it, right?
Right.
If,
I was just going to say that, but I wanted to keep it positive.
I know. Well, that I think that's how I'm made, and I think that we're pretty similar in that aspect. And we're also, at least I'm a realist.
Right.
I mean, this is our reality that we're living through right now, and it is a very challenging time for a lot of people, and uncertainty and fear and just emotions in general. And that is completely valid, because we did just lose 10 million jobs, and that number is going to double by, what did I say? Third quarter, by the end of the third quarter. So in the next 4 months,
right,
it's going to double.
Right.
And I do believe that, based on everything that I know and everything that I'm seeing, that the government is going to step in, that they're going to fix this and do the best job possible, and that we are going to see a rebound fairly quickly. Is it going to be painful for a lot of people in the next 3 months? Absolutely.
Sure.
So,
it's got to get a little bit worse before it gets better.
It is going to. Yep. So let's get back to so the Great Depression, we're at 20%, and I'm hearing a lot of people saying that we're getting back to the point where there are some comparisons to the Great Depression. So that gives some perspective, at least, where exactly the unemployment rate was during those years. So it got as high as 24.9% in 1933, 24.9%, and then let's fast forward to the Great Recession from 2008 to 2013. And to start that, we were at 7.3% unemployment. Went up to 10, and then 9, 8.5, 7, 7.9, and then 6.7 by 2013. And obviously dramatically less, yet nonetheless, that's some other perspective where they were at during those years, which those years were fresh in my mind.
Oh, sure. Yeah, absolutely.
It was not that long ago.
No.
So let's talk about the current crisis. 2020, it's estimated that we are going to get up to 15%. 15% unemployment in 2020. As I mentioned, Goldman Sachs, who manages the wealth of the wealthiest in the U.S., they have some real smart people that look at those projections, and it's probably going to be somewhere around there in all likelihood. So 15%, and then in 2021, 6 to 8%. 2022, the projection is 5%, and 2023 is 4%. So if we're going to go from 15% by close to the end of this year, and 6 to 8% in 2021, that means a lot of those people are going to have jobs again, right?
Right.
And
there's just so much demand right now, I think, is just a really important thing to keep in perspective. And I think we talked about that a little bit last week.
Mm-hmm.
It's just everybody is, it's such a different time because, it's not like people are unemployed or going through this hardship and still going about their regular daily lives. There's so much demand right now for everything that as soon as the orders start to get lifted, the floodgates will open, and that's where we'll see a really big rebound, at least not a complete rebound, but enough momentum to, I think, come out of the fog a little bit. I think everybody's just kind of in a fog right now, and we hear these numbers. We haven't even seen the true reality of it yet. But we will start definitely seeing that, especially when these orders start lifting, because we'll see, the damage that it's done to businesses and just local economies and whatnot. And then you'll see those local economies come out of that and truly rebound much quicker than I think anybody would anticipate. Of course, with the orders in place, 3 months is a long period of time to be stuck inside and not be able to go about your daily lives or go, to work and whatnot. But I think that if we can just hang in there for at least the second quarter, we'll start to see some relief by the third quarter.
Yeah.
So
sometimes it just doesn't seem fast enough though, does it?
Right. No.
Yeah. It's hard when you're in the moment.
Yeah.
Kind of on the same topic, but a little bit off, was I was on the phone yesterday with a state representative that represents my city, Wilsonville, and talking about how the city can participate and help in that, and maybe fill in some of the gaps where the federal and the state aren't able to, because this is going to take a team effort. It's going to take the federal government, it's going to take the state, and it's also going to take the local government to get everybody, moving in a positive direction. So,
right.
So I know that there are a lot of conversations happening along those lines, and figuring out what the best course of action is. And sometimes it's not clear, immediately.
Sure.
A lot of conversations going on about it. So
Yeah.
That is unemployment rates compared to the past financial crisis, comparing the Great Depression, the Great Recession, and the current crisis that we're in right now. And let's switch tracks just a little bit. I want to talk about what's happening in the local market, because a lot of that stuff that we just went over is on a national scale. It's looking at the past on a national scale. But what's happening right now in the Metro Portland market? That's a great question. Thank you for asking.
What is happening in the local market, Andy?
Thank you. So let's go to last week. Last week, the market stats in the Metro Portland market were 661 new listings came on the market. 661 new listings came on the market. In the previous week, we saw 879. So down just a little bit from 2 weeks ago. And 2 weeks ago was about the point where we hit a little bit further back, but not much. I mean, we were in this 2 weeks ago, right?
Yeah, absolutely. Yeah.
Yes.
Yeah.
So 879 2 weeks ago and 661 new listings this past week. 187 homes came back on the market. In the previous week, it was 260. So that number is actually down this week a little bit. And then we look at pending sales. It was last week was at 510 pending sales. In the previous week, 549. So pretty
okay.
even there, right?
Yeah, absolutely.
And then finally, closed sales, 617 closed sales. In the previous week, 544. So more sales closed this week. More keys were handed to home buyers and home sellers over the past week than in the previous week.
Wow.
So transactions are still moving forward. And I mentioned this last week, and I think a couple of weeks ago, that not one of our transactions has fallen through. And I know that that's happening. You know, people have lost their jobs, and that means that they will lose their financing.
Right.
And just know that there is movement in the market. 617 closed sales and 544. So that's over 1,000 home sales have closed in the past 2 weeks alone. And with 661 new listings hitting the market and 617 closing, what does that mean? It's like we're pretty level market right now, right?
Right. Yeah,
so
absolutely.
Almost as many new listings that are hitting the market are going under contract and closing. So as challenging as it is, I think just the industry as a whole, from you to real estate agents to title companies to home inspectors to appraisers to everybody that governs all of those different entities, they are all working hard to keep this train moving forward, because the housing industry is a huge portion of the U.S. economy.
Sure. Yeah, and I mean, obviously the entertainment industry, you know, whether it's food, beverage, bowling, you know, theater, all of that those industries are the ones that got hit the hardest. But in this day and age of technology and how much businesses are relying on technology, and you know, the technology sector is ever growing, we'll see a huge difference there, because obviously those industries are the ones that primarily keep the housing market alive.
Right.
So
yeah,
and it's a key factor.
And it certainly changed the way we do business. And if we're going to look at a silver lining in all of this, I believe that it's going to change our business that we're in for the better.
Yes.
I think that we're going to see some very positive things come out of this. I think we're going to see efficiencies and a sense of camaraderie that like we've never seen before. There aren't a lot of dividing lines between different brokerages and all of that I'm seeing.
Right.
I'm seeing everybody come together and work on this together to keep our clients moving forward to accomplishing their goals, right?
Yep, absolutely. Yep.
Talk to me real quick, because we were talking just before hopping on here about what you're seeing happening in the mortgage market, and it sounds like a whirlwind. It sounds crazy.
It is absolutely nuts. You know, loans are still getting issued, but banks are very gun shy right now for a lot of different reasons. One, we talked about before, they're really trying to control interest rates, because they will lose their shorts right now if interest rates drop too quickly, too fast. Mm-hmm. If they drop significantly too fast, because these banks have a huge portfolio of loans that they just did over the last 24 months. So if they lose the money that they would make on servicing those loans, that's a really big detriment. Couple that with the fact that there are these large unemployment numbers, and economies are suffering, they're very gun shy on moving forward and making sure that they're protected if they issue a loan. So banks are taking extra precaution in regards to the credit rating that they will accept. The total risk factor, meaning how much money somebody's placing down versus reserves that they have. There's all of these things that happen behind the scenes. And if somebody is borderline, banks reserve the right to say, we're not going to issue that loan. And that might be outside of the normal parameters of what we would typically expect. But they're trying to avoid what happened during the mortgage crisis, 2006, 7, 8, on through 2010. And so, constantly in the mortgage industry, we're getting updates stating that minimum credit ratings have adjusted, that certain programs are no longer being issued. So if it's somebody who requires a specialty program, or if you're over a certain loan level, so what we call a jumbo loan, a lot of those programs have become very narrowed. So somebody could have been in contract, they have their loan locked, we're in processing, and if that investor says, nope, this loan is now too risky, they have the ability to say, we're not going to issue this loan. And so, lenders are working very hard to reposition those loans, and have these conversations, because it's changing daily, on what was accepted versus what's going to be accepted moving forward, so that we don't end up with a housing crisis or a mortgage crisis. It's nowhere near what we experienced previously, but yeah, it is a whirlwind for sure.
Yeah. So I have a listing that happened on one of our listings. It was a jumbo loan, and that loan was swept out from underneath the home buyer. Our company is representing the seller, and they had to scramble to find a loan program that would work for them, because they went from like 8 to 10 different options, maybe even a few more, to maybe like 3 to 4 different options. And those options probably weren't as favorable.
Right. And those rates went up, significantly in that market. So if you went from one investor to another, not only did you have to scramble to find the right program, you're now readjusting your budget significantly. Because banks are trying to protect the position that they're in. And part of that protection, although that seems counterintuitive, is raising interest rates. So you'd think that banks would lower interest rates to make it more affordable so that people could purchase, but that interest rate is a safety net for that investor. The guidelines and their requirements, those are all safety net to ensure that they're going to make enough money to support issuing the loan. And so that's what we're seeing, across the board, regardless of the type of program. Interest rates right now do not match what's happening in the mortgage market. And that's because these banks are really trying to evaluate what they can do. And eventually the Fed, because the Fed is pushing money and they're buying up mortgage-backed securities, the rumor is that they're going to start buying up loan servicing. So they're going to be packaging up these loan services so that interest rates can lower, so folks can continue to purchase and take advantage of these low rates. But we just haven't quite seen that yet, because there's just so many moving parts behind the scene. So as soon as they start figuring out the logistics of that, we will start to see that, and the money will continue to flow. And we really need that to happen for a lot of reasons. The housing market is what drives our economy, a huge part of it. So just take some patience. And for people that are in the trenches right now trying to purchase, it's just making the best educated decisions that you can with what's happening, so that you can still get into that property. And interest rates are still fantastic.
What are they?
We're in the high 3% right now. So anything, honestly, anything below 5% is phenomenal. So it's just that anything a sub 4 even better, but
take it.
Yeah. Right.
Yeah. So what's the best advice that you have for consumers and home buyers today?
Oh gosh. Well, just that, to keep it into perspective, to understand if the numbers work, then make the most of it. Lock in that cost of living, and gain that good appreciation that we've talked about, because that's going to continue. So those are the main reasons that people should make decisions when looking at where they're going to be living, is locking in that cost of living, having a payment that makes sense. The interest is still tax deductible. So take advantage of those tax deductions while you can. There's no crystal ball on exactly where rates are going to go, how low they're going to go. And so you do what makes sense, and you move on it.
Do what makes sense for you and move on it. That's my quote of the day. Deal?
Love it.
Okay.
How about you? What is your
that?
advice? What's your advice?
My advice, I would say, is number one, if you have a real need, then it all starts with a conversation. You have a conversation and educate yourself on what all of your options are, and then make the best decision possible for you, right? And if you don't have a need and it's just somewhat of a want at this point, then I would start putting the pieces in place and get through this period of time, because there is more risk, that the health risk that we're going through right now, as much as everybody is doing the best job that they possibly can to minimize that and keep our people safe. And in Oregon, I think that they've done a really good job looking at the numbers compared to a lot of states, especially surrounding us. We're surrounded by Seattle and San Francisco, right?
Right.
And you compare our numbers to theirs, and it seems to me, and I'm no expert on that, but it seems to me that there's a dramatic difference. And
sure.
And I do feel like we've done a good job of keeping people safe. And, in our business and in the industry as a whole, I think that everybody has put pieces in place to protect their buyers and their sellers and keep them safe. So I think that's awesome to see.
Yeah.
And with that being said, put the pieces in place. So it starts with a conversation about your financing options, because as you mentioned, there's so much that's changing right now. So it starts with that conversation, understand what your financial options are and where you're at financially. And then start to keep an eye on the market, see what's happening in the areas that you're interested in, just to keep a pulse on what's going on. And you just never know. Maybe you're in a great position to do something and your want turns into a need because a home comes on the market, which we saw a lot of new homes were coming on the market. Maybe that perfect home came on the market and you're like, that is my dream home. So that want just became a need.
Right.
Maybe not technically a need, but in people's minds, that I see it happen all the time.
Right.
That perfect house comes on the market and all of a sudden they feel like they need it.
Right. Happens all the time.
Yeah, it totally does. And it totally does. And there's nothing wrong with it. We know what we want, and we want what we want. Sometimes we have the ability to get it and you just go out and make it happen. Right.
Right. Absolutely.
So that would be my best advice, is just keep a pulse on what's going on in the market. And if you have a serious need, then start to put the pieces in place. And if you just have a want, start to gather the information and see what makes the most sense for you. So that is my 2 cents.
I dig it.
Yep. Okay, my friend, do you have any parting words for our listeners?
Man, I mean, I feel like the same message is just the main priority right now is staying healthy and staying sane. I think the novelty of the order after the first week or two is kind of wearing on people. And so do whatever you can to take care of yourself. It will get better. Any professional out there will tell you it will pass. We promise. So you just got to hunker down and take care of yourself in the meantime. And, like I said last week, winning fixes everything. So when we start seeing some good wins, then we'll be on the road to recovery.
Yeah. Along those lines, I try to find a win every day. Like I start my day with my team with a win, regardless of how small it is. We want to start our day on a positive focus. And that means finding something positive, finding a win, something good that happened in your day, the previous day. And like let's just keep building on that, even if they're small wins,
Right.
So I would like to leave with saying one more time that if actually what I'll do is I'll post the slide deck in the comments. So that way, anybody that watches this in the future, they have them right there. So that's what I'm going to do. I will leave the slide deck in the comments. Feel free to browse through them. I probably skipped and missed a bunch of stuff that I should have gone over. And you know, I'm human, and technology sucks sometimes, and you know, frustrating, all that stuff. So I will leave the slide deck down in the comments, and we'll go from there. So
Awesome.
until next time, are we going to meet again next Monday?
I'll see you Monday, 12:30 sharp.
12:30 sharp. We'll be live, providing you guys with the information to make smart choices, both now and moving into the future. So I hope that you stay safe. And like Annie said, stay sane. I see Facebook going crazy right now. It's very, very entertaining. And make it a great day and a great week.
Awesome. Thanks, guys. See you next week.